Another factor which you need to look at when investing in equity stocks is the size of the company. We've discussed about the fact that equities are the highest risk, high return asset class, but within equities also, the size of the company determines how much risk you're taking. Go right now and click on the link in the description below and register for our course Namaste Money. Basically, the size of the companies is divided between large cap companies, mid cap companies and small cap companies. Let's look at each of them. Large cap companies basically refer to the top 100 companies by their capitalization. So if the entire market were to be put in the order of the companies in terms of the size of the companies, the top 100 largest companies qualify as large cap companies. The next 150 companies, that is company 101 to 250 by its market capitalization, these are the companies which qualify as mid cap companies, and all companies after the 250th company or from 251st company onwards, they are called as small cap companies. To give you an idea, Reliance Industries Limited is a large cap company and it had a market cap of 14.53 lakh crores. Versus if you move on to Bata, which is a mid cap company by size, it had a market capitalization of 18,100 crores. You can already see the difference between the size of the large cap company versus the mid cap company. Versus you move on to PVR Cinemas, which is a small cap, it has a market cap of 2,659 crores. These are all numbers based on the traded values on September 21st, 2020. The market capitalization of a company, which is nothing but the total number of shares multiplied by the share price of the company on any particular day, changes on a daily basis because the share prices change every day. But this gives you an idea of what a large cap, mid cap and a small company would look like. Now, why it is important for you to understand this is the risk and return of a large cap company is lower than the risk and return associated with a small cap company. Let me explain this with an example. If you look at State Bank of India, which categorizes as a large cap company, it has close to 24,000 branches in India today. Versus if you look at AU Small Finance Bank, which is considered a small cap company because of its size, has only 400 branches in the country. Now, if you were to put your money in a company like SBI, State Bank of India, do you think the company can double its profits in a year? And if doubling profits requires it to double the number of branches or even increase the number of branches by 50%, do you think it's possible? The company is so huge that it cannot double in size. It is already way too large. It is going to grow at a steady rate, but doubling in size, it's a big question mark. Versus an AU Small Finance, which has only 400 branches, if it wanted to double in size, can it double its branches to 800? Yes, it has been done in the past and can easily double its number of branches in a year or maybe in 15 months to 18 months. So if AU Finance is able to double its number of branches, double its lenders and borrowers, double the amount of money they're able to give out, they can actually double their profits and expect their share price also to double. But at the same time, do you think an SBI can shut down overnight? If there is any risk in the market or if a systematic or unsystematic risk hits the company, do you think SBI can shut down overnight? No, SBI is way too large a company. It has enough size in its balance sheet to weather all the kind of risk and it will not shut down overnight. Versus the AU Small Finance Bank, which is still a very small bank, the chances that it can shut down if an event were to hit it and it does not have adequate capital to face the market risk that it is exposed to, the chances are much higher there. It can be a well-run bank, but if you were to do a comparison between the two, AU Small Finance is a small cap company and is associated with high risk, high returns, whereas SBI comparatively is a much larger company, and compared to AU Small Finance, you would expect lower risk and lower returns when you invest in SBI. So when you invest across various stocks, an understanding of these parameters helps you gauge the amount of risk that you're taking when you invest in a particular company. This does not mean that when you invest in a large cap company, there is no risk or there is very little risk. Equity as an asset class carries with it high risk, high returns, But within equities, we are able to segregate between large, mid and small cap companies so that there is a further detailing to how much risk you are ready to take as an investor. Again, if you go back to the history and see, it is not uncommon to see even a large cap company fall by 30% in a financial year or give you a 50% return in a financial year. But having said that, relatively they are of a lesser risk compared to a small cap company. Hope you enjoyed watching this video as much as we enjoyed creating it for you. So what are you waiting for? Go right now on the link provided in the description below and register for our course Namaste Money. This course is an online course which will teach you all the basics about your personal finances and answer the questions of where you must invest, how you must invest, and more importantly, why you must invest in a particular investment product. Also, don't forget to like, share and subscribe to our channel for freshly brewed content from Wealth Cafe. And don't forget to save hard and invest smart.